Hi everyone, I hope this video finds you well. This is the second lecture related to Chapter 12, Inventories. If you have not watched the first one, or first set of videos related to the first part of the chapter, then I suggest you stop this and go back. Because essentially what we do is we work through the audit risk model, looking at the assertions, looking at the inherent risk, the control risk, including the tested controls. And so really want to make sure that you understand those before we kind of move on, because today we're going to talk about substantive testing. And so if we look here, this slide is kind of encapsulated in this next one, and I think I've said it before, but these summary slides like this, where we have the procedure and lined up with, really these are assertions. Even though they're calling them audit objectives, they're really assertions at this level because they're not being specific to the actual transaction. But these are nice because in one place you can kind of see the test and you can see the assertion that's related to, and it's good for you to, if you can kind of take these and then make sure you understand, well, why is it that this test helps with existence or completeness or evaluation. And so there's several here. Just want to mention, so we're going to spend some time in the next couple of slides basically talking about several of these. So I don't want to talk too much here, but we'll talk about the taking of the inventory. We'll say in terms of evaluating, observing, testing its accuracy. We're going to spend a lot of time talking about that, and that relates to existence because we're essentially going to say, okay, your accounting records say that you have all this inventory. Let's actually go back in the process and make sure that you can go back to the transaction or really the asset and make sure it's there, right? And we'll talk about a few of these others as well. So I don't want to spend too much time, but this is just a good place to make sure you come back to on this slide after we've kind of gone through details and stuff, to come back to make sure you understand why they help with these particular assertions. Okay, so looking at the inventory observation first, this is probably one of the most important substantive tests related to inventory. I think in the first lecture I talked about that McKesson and Robbins fraud case a long time ago. And basically, auditors used to not be involved in the physical inventory account, and that fraud kind of showed how much risk there is in doing that. So now, if there's a substantial amount of inventory, then the auditors are usually going to focus in on the inventory count. And so, to be specific here, the client is the one that actually does the count, because that count is going to impact what they mark their inventory as, right? And so that's part of record keeping. And if we're auditors, we're not supposed to do the record keeping, right? So we're not responsible for doing that count, but we're going to be involved. And so we're going to supervise and observe several things in this process. One, we want to make sure if they're going to do the count that they include all the items. They're not just including, for example, I think about like a Lowe's. You're not just including like the lighting department or just the appliances, or skipping out on the lumber, for example. We want to make sure that they include all their items with their inventory count. Make sure that once there's a set of instructions, that the employees that are actually doing the count are actually complying with those instructions, because there's usually very specific ways you have to do this count. Often you have to make sure that they are including or taking account of obsolescence, obsolete items or damaged items. And so we want to make sure that they have a way to record that. And then we'd want to make sure that we as auditors know, okay, if they're going to take an inventory on a certain day, then, okay, what are the final receiving reports that they would have had before that? And then what would be the final shipping documents before that? So we want to make sure that ultimately when they do the count and they compare it against the accounting records, that those accounting records are up to date as of whatever transactions would occur before, or right before they're taking the inventory. And then doing test counts. So the auditors are going to occasionally do some test counts. Not occasionally, they will do some test counts as part of the inventory, so that the client will say, okay, they're going to count the inventory themselves, and then the auditors will come behind. Let's say it's, plywood. I just was in the market for buying some cabinet grade plywood at Lowe's, right? And there's some stuff that's really nice, and so let's say they say they have 15 sheets that are down below, and then they have another 30 sheets that are up higher. And so I'm going to, as the auditor, I'm going to go in, I'm going to count that. If I know that's one of the items they're going to count, I'm going to count that, and which they will. They're supposed to count all items, but I'm going to count it and then make sure that their count matches up with my count, right? So I'll do that on a sample basis. I'm not going to do that for everything, but I'll do it on a sample basis to make sure that they're including or counting accurately. Now, if the auditors are engaged after year end, then that presents a problem, right? Because we can't observe. So if we're unable to observe the taking of inventory, then it could be, especially if the inventory is material enough, that we can't actually express an opinion, right? Or, right, we might have a disclaimer. Bring right a disclaimer. This is tricky. All right, so I'll get disclaim there. But basically, in the opinion, saying, look, we were engaged after year end. Maybe they fired the auditor from last year, and they didn't hire us until after they did their physical inventory count. We're not going to be able to express an opinion on the inventory and the related accounts like cost of goods sold, right? And so that's a possibility. Or if you have some other conditions, you might be able to be satisfied. So they have strong internal controls, right? You can test internal controls. Maybe you looked at working papers from prior auditors, and so you get evidence there. If they have perpetual inventory records where you can go back and recreate. So maybe you could do a test count at some point after you've been engaged, or have an inventory count taken, and then you can work backwards with a perpetual inventory and have a good sense that the ending balance from the prior year, the year you're auditing, lines up with what the perpetual inventory records say. And if they have good documentation, and they planned out, did a good job planning out their physical inventory count. So even if we weren't there to observe it, if they have sufficient documentation that they executed that physical inventory count, then that would be also be helpful. And then lastly, we can do some test counts to make sure, for example, their perpetual inventory records, if they line up with those test counts, then we feel more confident that the ending balance was accurate, because again, assuming that they have perpetual inventory records, it means that any point in time they can tell me how much they should have of a certain item. I can go and do a test count or a set of test counts, and then I can feel more comfortable at that point. Okay, so it's not impossible to get comfort if you couldn't observe the inventory count yourself as the auditor, but it's going to take more conditions for that to be the case. Okay, so Some of the things we do around inventory is testing for cutoff. And so we're going to look at the invoices that purchase new inventory and receiving reports where we receive the inventory. We're going to look before and after the inventory date. We want to make sure that if we purchase an inventory that the liability was set up and that the inventory was properly increased, and make sure that we have those being done in the correct period, right? And obviously if we have, this is also going to depend on shipping terms, right? So if we have FOB destination, then receiving reports are the date where we actually we want to see the client recorded liability, because that's the date they actually incurred the liability, right? Is the date they received the goods. And so we'll test to make sure that's the case. If it's a FOB shipping point, then whenever the vendor shipped it is the date that we should record the inventory in our books, because that's the date that the risks essentially transferred to us, right? And so we would examine these documents before and after to make sure that the inventories were recorded in the proper period. As far as pricing goes, we're going to look at the method. So LIFO, FIFO, weighted average, dollar value LIFO, all those different variations that could be used. What are they using? Does it seem appropriate for the firm, for how prices have changed over time, for looking at methods that other competitors in their same industry have used, those types of things. Have they changed the method? If they changed it, then obviously that's a whole another set of procedures as far as making sure that that change was done correctly, and making sure that it wasn't done in an opportunistic way. Right? Did they change just to get a different effect on the income statement, for example? Because if you change the method, then you can change the cost of goods sold and thereby change the earnings. And you can do some testing to make sure that it was actually done appropriately. In terms of, if it's LIFO, then you're going to make sure that that method was followed in terms of the application of the inventories. And then, lastly for this video is looking at an example of a working paper. And here we have an example of a pricing sheet for raw materials and purchase parts. And so you see all these parts that have been purchased by certain vendors, how many, what the price was, and they're going to basically, as the auditor, you're going to look to see, okay, here's what they recorded as, and then I want to go and actually look and see what the vendor's invoice says as far as the quantities and the prices, and make sure that those things agree, right? And so and this is an example of, even though these are manual tick marks, like these little Y's on the end, you have electronic work papers that are going to do the same thing, right? You're going to make sure that those prices, we can tie those back to the invoice from the vendor to make sure that those were priced accurately. And then I'll pick back up in another video with the data analytics.